Hey, Steve Saretsky here. Welcome back to the show. Lots to touch on this week. We had some large movements in the bond market. Going to walk you through some of that and the mechanics that I think central banks are going to start looking and paying attention to moving forward, as well as how that's sort of feeding through into the housing market and really focusing on some of the economic data that's been coming through, particularly in the labor market, which is what everybody's ultimately, and central banks included, are paying attention to. So I'm going to unpack all of that for you this week. But we have to start off this week, which is, we've been talking a lot about the movement in bond yields over the last, 3-4 weeks on this channel. Last week we did a video on it. We updated you on the movement in the Canada 5-year bond. Well, we opened up this week. Keep in mind, we had a long weekend. So markets were closed on Monday in Canada. But the Canada 5-year bond yield opened the day on Tuesday up 20 basis points for the day. Because again, remember, markets weren't trading on Monday, so they're basically playing catch up with the U.S. market. And so a 20 basis point move for the Canada 5-year bond yield is like insane. Like on one day, I mean, that just is like screaming major red flags. This is not a normal, healthy move. If you talk to anyone that works in the bond market, that trades these on a daily basis, they'll tell you the exact same thing. That level of volatility is not indicative of a healthy, functioning market. And so that kind of leads me into the next thing, because ultimately the U.S. bond market is the largest, deepest, most liquid sort of asset class in the world. I mean, at least so it is. It's supposed to be like it's the interest rate that basically sets or prices global assets, and so this is what really everybody trades off of, right? You need to settle, global trade. You settle that basically using U.S. dollars and U.S. treasuries, and so this is like the pristine asset that everybody pays attention to. And right now we're getting 10 basis point moves pretty much, maybe not quite on a daily basis, but very, very frequently we're getting 10 basis point moves. And so again, I just want to illustrate to you how not normal this is. And this is something that we're obviously paying close attention to. So there was a guy called Harley Bassman. He is a guy that created the MOVE Index. The MOVE Index is essentially a bond volatility index. So it measures the volatility in the bond market. So he created, you can go ahead and Google it. It's called the MOVE Index. And so he says, his words, not mine, the MOVE Index at 150. So when it hits 50 is basically suppressed. Central banks are artificially suppressing them. And 150 is central banks have lost control. He says the MOVE Index at 150 infers interest rate changes of about 9.5 basis points per day, a volatility that is unsustainable, if only because human beings cannot tolerate such stress for long periods of time. Again, this is Harley Bassman, the MOVE Index. And so if you look at the MOVE Index, we're not quite at 150. We're kind of between we're bouncing between kind of 130 and 140 right now. But yet, bond yields are still moving more than 9.5. They're moving about 10 basis points a day. And so this, again, indicates that central banks have lost control of the bond market. Now, again, that MOVE Index fell down to around 50 during the depths of the pandemic, right? When the central banks were actively and artificially managing the bond market, right? Massive amounts of quantitative easing, buying up government debt, corporate debt, municipal, provincial debt, you name it. Central banks were buying it. And so this was artificially suppressing bond volatility. It's also part of the reasoning why you had interest rates at 1,000+ year lows. And so they sort of kept that beach ball submerged under the water. And of course, now you've got the MOVE Index getting closer to that 150. You got this massive bond market volatility, but sort of the analogy of keeping the beach ball under the water has obviously surfaced and is creating a lot of issues in financial markets. Now, again, this hasn't necessarily created this massive sell-off, but I think we can all be aware that these levels of interest rates, we've gone from basically zero interest rate policy for the last 15 plus years. And to think that you're just going to go from 0 to 5 at normalized rates in a span of 18 to 24 months and not have anything go wrong, I think it's just this complete misnomer. But nonetheless, we're kind of just waiting for the data to get worse. And so, the bond markets continue to look and say, well, nothing's broken yet. So they just keep pushing yields higher and higher and higher. And so we're going to get back to that because ultimately, I think, like I said, this is feeding through into interest rate sensitive markets. You can think of the auto market, which I think is struggling. We see companies like Tesla doing I think their second or third price revision this year, which shouldn't be surprising when you consider finance rates on vehicles are hovering around 8%. I mean, it's just hard to finance a very large item at 8%. And, you look at housing, the Canadian housing market continues to slow rather aggressively. Like there's been a market shift in the last 6 to 7 weeks. Activity has slowed, sentiment has changed completely. We got the recent data here out of Vancouver and Toronto. Vancouver, while sales are up year over year, they're coming off 20-year lows last September. So September home sales are actually 25% below the long-term 20-year average. So very, very weak demand. New listings finally getting back to more normal levels. Technically 5% above the long-term averages. You're finally getting sellers back to market. And remember, the reason why prices stopped falling and actually accelerated into the spring market was because you had 20-year lows in new listings for the majority of the year, and that basically suppressed prices. And so now you're finally getting the normalization in listings. Sellers are finally saying, okay, I got to test the market. I might have held off. I'm now testing the market at a time when, again, demand is 25% below long-term averages, not even adjusting for the population growth here in Metro Vancouver. So we're seeing prices now coming off. Again, housing is just very, very slow to adjust. If you think about most sellers, right? You list your house for sale. You see how the first 2, 3, 4 weeks go. Then you might, week 5, week 6, you might look at reducing the price. It doesn't sell. You wait another couple more weeks. You reduce the price again. You take it off the market. You change your realtor. You hire a new guy. And you put it on at the old price again. So it takes a long time to work its way through. But nonetheless, I think that mortgage rates at these levels are going to create lower prices over time. And so again, the key part being interest rates and where they're going to be, 4 months, 6 months, 12 months, 18 months from now is going to really determine the trajectory of the housing market. But similar thing in the GTA, fewest home sales since 1996. So again, inventory now, again, when you get that week of sales, it slowly allows inventory to build. That then puts more downwards pressure on prices. So again, the medicine is sort of feeding through, and you're just waiting now. You're just waiting for the data, like the larger economic data, to kind of roll over. And it's just been so stubborn. The one data point that the central banks keep talking about is the weakness in the labor market. We need to see labor market weakness. We need people to lose their jobs so we can get wage growth down. And when we get wage growth down, that's going to reduce, people's purchasing power. It's going to reduce the basically the leverage that workers have to negotiate higher salaries, which can feed through into higher prices. So again, central banks are actively trying to sort of screw the blue collar working class individual. They need them to lose their jobs so they can get inflation back under control and then normalize interest rates. Because you'll remember, if you look at the central bank's own prognosis, is they have the neutral level of interest rates significantly lower than where it is today. And the neutral level means where we see them on a longer term basis over the next couple of years. And it's not at these levels. It's kind of between 200 to 300 basis points. So central bank, again, needs the labor market to weaken before they can actually actively cut rates. And we're just not, the headline numbers are just not feeding through into the labor market headlines. And so if you look at it, we had the US, for example, this week, which everyone was holding their breath on. U.S. job, the payrolls data came in, added 366,000 jobs. The estimate was for 170,000. So, huge. Everybody starts freaking out. Same thing on the Canadian side. We added 60 something thousand, which is well above expectations. But again, keep in mind, like, this data is so prone to revisions. And if you actually kind of like look under the hood, you can really start to see things are actually not quite what they are being proposed to be. And so, one of the things I'd point you out to in the US of that number, so full-time employment is down 692,000 jobs over the last 3 months. The last 3 times that happened was 2001, 2008, and 2020 during the pandemic. So again, they've lost 692,000 full-time jobs over the last 3 months. And if you unpack that even further, so in this latest jobs report, full-time workers were down 22,000. Part-time workers are up 151,000. Wow, that's a lot of people adding part-time jobs. Well, multiple job holders, 2 people having, 1 person having 2 jobs, was up 123,000. So basically what it tells you is you're losing full-time employment. You're adding more part-timers because people are getting second jobs. And I think they're probably getting second jobs to cover the cost of living, which is obviously crushing a lot of households, not only in the US, but in Canada. And that's kind of what you're seeing in Canada. Was actually hours worked has been declining. And so you have to kind of fit in. You got this rapid population growth, and I just don't think I think we tend to overthink things that that this is just going to continue in the labor market, and we've defied economic gravity. But I think at the end of the day, it's when you hold rates at 0 for 15 years, and then you add on the fastest rate hiking cycle in modern history in the span of less than 24 months, then naturally something is going to go awry, and it's only a matter of time until that it filters through into the official data. But a long story short is central banks need the air cover, they need the excuse and the rationale to actually look to cut rates. And so it's pretty hard to cut rates when they say, the estimate is 170,000 jobs, but we added, 360,000 plus jobs. So how are you going to cut rates? And so the longer that the longer that the headline data remains good, because it looks on the surface, it looks good. The longer that it remains good, the longer that rates will have to stay higher. And the longer that rates stay higher, I think it does a lot more destruction underneath the surface, which is there's people carrying large losses in large portions of the market. Particularly, you think all these people that bought bonds at 0 interest rates, and again, we've talked about this on the Loonie Hour show, but so that's where I think ultimately we're waiting for something to crack. And so long as the data continues to more or less, at least on the surface, hold up, it's going to be more painful for, I look at, again, Canadian households where there's no immediate reprieve in the immediate future. Now, I believe it's next week. I think we're getting Canada CPI, and the week following we're getting the Bank of Canada coming out. So we got a couple interesting data points coming out. But nonetheless, I think when you look through this, I believe the Bank of Canada will remain on hold. I think that they're done. But again, done does not mean cutting anytime soon. And at the end of the day, the bond market, again, moving 10 basis points a day, is doing the work or the tightening for the Bank of Canada. And so that's kind of how I'm looking at it. So again, pay attention to the MOVE Index, Harley Bassman. We're actually going to try to get him on the Loonie Hour show. We've got his colleague, Mike Green, I believe, coming on next week. So hopefully we'll have Harley on the show, several months from now. But Mike Green should be on the show next week. I'm going to highly encourage you to check that out. As always, see you next week.